Welcome to Make It Last, helping you keep your legal ducks in a row and your nest egg secure. With your host, Victor Medina, an estate planning and elder law attorney and certified financial planner.
Everybody, welcome back to Make It Last. I'm your host, Victor Medina. I am an elder law and estate planning attorney as well as a certified financial planner. I got more hats than I have heads, but it's certainly fun to be helping people in this way. I'm so glad that you can join us on Saturday morning. I tell you, I am excited for this show. We're going to talk about one of my favorite topics, which is annuities. And no, don't do now. This is going to be a good one. But before I get there, I want to share something with you real quick, which is that over the last week or so, I had the opportunity to meet with a great client of mine, and it was one of these meetings where I had built it up in my head because I was, to be frank, very nervous about it. I wanted to meet with this client because I wanted the opportunity to learn a little bit more about what they liked about what we do, because I wanted to be able to kind of copy that, serve them fantastically. I just want to give them, everything that they think that they need in that kind of relationship. But I also want to know what makes them tick, because if I can do that for them, then I can do it for other people and get more people like them. Anyway, I built it up in my head, and I was very nervous about it. And I don't get nervous about a lot of things, but I was nervous about this meeting, and I didn't want to blow it because I knew this was my opportunity to really kind of learn about these people and learn what it is that they liked about us, and I didn't want to miss that chance. So what I ended up doing was preparing for it for the better part of the week before we had this Friday lunch. And what came out of that meeting, there was a bunch of stuff that I learned, which was great. But what came out of that meeting was their desire to kind of know a little bit more about me and see that in the communications, see more of the personality that I have and have that come out in the meetings and challenge them and really kind of work with them and make sure that they're doing the right thing. And so they wanted not more of me present, physically present, but more of who I am within the process of the relationship. All right. And then about a week before that, I was standing outside watching my middle son play soccer with another parent. And so within the group of parents, I'd been charged with rounding up volunteers for this tournament that we were doing. And over that time, I was sending out funny emails trying to cajole them into taking these volunteer jobs because they weren't paid and wasn't a requirement per se for you to do it. But, I figured catch more flies with honey. And so I was trying to be funny with the emails and get people signed up, and people were having a lot of fun with it. And so anyway, he was talking about that, and he said, I'm trying to figure out in this new team, we're just going to give you free reign to send out these emails whenever you want. If you can make somebody laugh, go for it. And so they actually did that. It was kind of funny to read. He says, and Victor Medina, he's got unilateral authority to send out whatever email he wants. But when I was standing next to him, he mentioned that he had listened to the show. And it made me think that, whatever it is that I think is funny, I'm not really showing that in the show. And those two things kind of came together over the weekend. I was thinking about those two things, and so I kind of made a commitment. And that commitment is that I'm going to largely let my personality shine through this radio show going forward. And whatever that is, it'll either attract people or it will repel people, but it will be a little bit more of kind of who I am, because the way that I started this, and I don't know, we're about 15, 16, 17 episodes in, I was very sort of stoic and wanted to be an educator and teacher, a little bit of an entertainer, but, just wanted to make sure that that I was providing value in every one of these things that I was producing. So I'm still going to do that. And those of you who've been listening for a while, you kind of recognize what the structure of this is. We go ahead and we take the first segment and we talk about something that I find interesting, that I think you might find interesting. Then the second segment, I try to teach you something, kind of more academically, kind of educating you. And then the third segment, we talk about how you can practically use that and use that information in your lives. And so I've always kind of committed to doing that way. Well, to be honest, that way you're committed all the way through the whole 30 minutes of the show. So you learn them what's important by the end of it. But, it was good structure for me, and I can kind of lay it on top of on doing this 30-minute show every time that we do it. So we're going to continue with that, but I'm going to try to do a lot more sharing of kind of what's going between my ears when I'm thinking about something, especially in the first segment, so you know a little bit more about kind of not what makes me tick, like you're interested in me, but a little bit more about how I approach things so that you can see a little bit more of the personality and my philosophy and that kind of stuff. So we've only got about 2.5, 3 more minutes on this segment, so I'm not going to have a full time to do it today, but but I guess tune in next week is the best way of saying it. So here's what I want to talk to you about today. This one's really about kind of image. There was a New York Times article that talked about a financial advisement firm that was in New York City and kind of talked to how they were in some cramped quarters and how they didn't project the typical image of what a financial advisor kind of looks like. And, they talked about how the place is down the street, the bigger wire houses, they've got, artwork in the lobby that they walk everybody through, and you're looking at your own money in a box behind a pane of glass. And they basically went away from the concept that you should invest in image, that it's not about selling the sizzle so much as it is about the steak. And it really got me thinking about the way that we've approached this over the years, because, for me, there are certain things that we decide to do in the office that are really about making sure that we are using the best tools, and we're doing the things that work as opposed to things that look good. So I'll give you an example. I'm a big proponent of using Apple computers. I love the Apple computer, and I've been using that since the very beginning of my practice. In fact, one of the things I got known for a little while was being a Mac lawyer, or being, somebody that knew how to use Macs in the law office, because for a while it wasn't very popular to do. I even started a little conference for Mac using attorneys. But the reason why I got onto that kick was largely because I wanted to make sure I had a machine that worked when I needed it, and I didn't have to invest in an IT department. And so I spend premium dollars when it comes to it on the machines that work, not because they look good and not because they are sexy in terms of the gadgets and things like that, but because they are the right tool for the job when we need a tool for the job. And so I've been thinking about that a lot in terms of the difference between the image and being effective. And it happens very frequently out in the community, especially community in terms of advisement. Lawyers need to look a certain way. I was told when I was coming up that lawyers shouldn't have beards. I don't know why. I don't know if it makes them look like a hippie and it's back to the communist thing, but they shouldn't have beards. And so, I stayed largely clean shaven from that. I'm not going to grow a beard largely because my wife doesn't like it. But it did make me think that a lot of our preconceptions about what image needs to be for anything in particular, they can be challenged. Because at the end of the day, what you want is somebody that knows what they're doing, that isn't worried about the sizzle so much as making a great steak. And so I just think that that's super interesting to think about and talk about. All right, so that's good for this segment. I know I blew a lot of time talking about my meeting with my client, but when we come back, I am going to teach you first about annuities, specifically fixed indexed annuities, because they're the big talk of the town, and then we're going to talk to you about how to determine whether one is right for you, and take a look at them, tear those contracts apart so you understand a little bit more about it. So stay tuned. When we come back from the break, all about annuities. We'll catch you on Make It Last. We'll be right back.
Hey folks, there are more than 500 different ways to claim your Social Security benefits, and most Americans will rely on their IRAs and 401ks to survive retirement. The pressure to make the right decisions at this stage of life can be enormous, as are the consequences for making a wrong decision. Victor Medina, host of Make It Last, is a certified financial planner that specializes in helping people in or nearing retirement. Working with families that have been diligent savers and who value a trusted advisor, Victor is able to put together a customized total protection retirement plan that helps clients answer 4 important questions. Can you afford to retire? Are you overpaying your income taxes? Can your portfolio be improved? Can you eliminate or reduce threats to your retirement? It's never been more important to make sure your ducks are in a row, and it's never been harder to make your nest egg secure. The time to act is now. Call 609-476-9269 or email info@privateclientfamily.com to schedule your no-cost, no-obligation first meeting and get on the road to total protection.
All right, welcome back to Make It Last. This show, we're going to talk a little bit about annuities. In fact, we're going to talk a lot about annuities. We're going to take the next 2 segments and kind of discuss everything there is to know about a specific kind of annuity, which is a fixed index annuity. Seems to be all the rage these days. Everybody wants to talk to you about them. And the really question is, why? Why is this being touted as the solution for everyone, and is it right for you? It doesn't matter who I meet with. There are strong opinions on both ends of the spectrum. People either love them or they hate them, and they do so with such a passion. You would think that they had a child who worked for an annuity company or something like that. Their future was based on loving these things like they invented them. So it's important to kind of understand a little bit more about these products, because that's really what they are, and then we can talk a little bit about how they're right for you or not. So let's kind of lay the groundwork first, which is that when we think about annuities, these are products that are created by insurance companies. And so largely speaking, they're sold by insurance agents. And when you get a discussion about them with somebody, they're in some connection with an insurance agent, somebody who's making a commission. Now, as you all know, I'm a certified financial planner, which is to say that I'm a fiduciary. I am product agnostic. I really don't care who is providing the product, because at the end of the day, we make decisions that are in the best interest of what our clients need. And so if we can go ahead and pick from anything out in the world, we're going to go ahead and pick the best thing that's out there, not necessarily the thing that pays us the most money. That's kind of the way that other brokers work. Now, so since I'm a fiduciary, and since I can pick from anything in the world, and I'm only going to pick the best things for my client, it gives me the opportunity to analyze these things from a different perspective, right? I'm not an insurance agent that has to sell anything in particular. I don't make any commissions off of the sale of any securities that we offer. And so we're able to kind of look at these things a little bit more objectively and try to figure out what makes them tick, why are they good, and when should we use them. To understand all of that, you can have to understand the way that these products are created, okay? And so these are insurance products that are put together to help people solve particular goals. Way back when, annuities were used to insure against pension payments that had to last a certain lifetime. So insurance companies are really good about actuarials and understanding how to properly put together a contract and agreement so that they can get payments to last and take on the risk of longevity. Okay, that's the way insurance companies work. They do that for a life insurance policy, and they do that for annuities. So the insurance company got into the business of sort of providing annuities for pensions. If you think about your pension is essentially an annuity. It is a structured payment for the rest of your life. Okay, well, that seems to make sense. Now, how are we going to use that product for other people's retirement, specifically for people that don't have a pension? Well, the insurance company ended up creating 3 different kinds of annuities, and I will tell you, I like 2 of them, and I hate 1 of them. The 3 different kinds of annuities is they can give you a fixed annuity, and that's essentially a guaranteed interest rate for a period of time, and that's like a long-term CD. That's basically what it is. Then you can get an annuity that is a fixed indexed annuity, and that basically has a floor where you will never lose any money, and a ceiling that is usually capped. It's some index that's out there. So you may not make everything that the index performs, but you can make some of what the index performs. I'll go into a lot of detail about that because that's what this show is about. So we'll spend a lot of time on that one. And then the last one's a variable annuity. And the variable annuity is essentially a way of wrapping traditional investments with an insurance contract. And that one, you can lose all of your money, and you can gain an unlimited amount, right? So you have, negative infinity to positive infinity. Now, as some of you know, I wrote a book on retirement income and retirement assets, financial planning, and I have a chapter in there where I talk about how much I hate variable annuities, because I do. Now, I've already spent some time on other shows talking about why I hate variable annuities, so we're going to spend today talking about fixed indexed annuities, the way they work, and why they are amongst the products that we select for people, and why we think that they're good alternatives and good ways of having things inside of their portfolio. So to understand the way that fixed index annuity works, you have to understand the way that insurance companies make money largely. They make money by taking premiums and investing those premiums in long-term treasury bonds, so that they pay off a steady amount of interest over time, and then their operating expenses go off of those interest payments. So essentially, they make more money than they spend, and they're generating money based on the investments that they have. Now, they can't invest all of your money. In fact, there are some regulations about how much cash they need to have on hand, both to meet their operating expenses as well as to meet any claims that are out there. One of the best companies is Nationwide by their ratings. And the reason why they're often touted as so good is that their economics are so good. They might have, 300% of all claims on cash on hand and 600% of operating income. And so that's just a way of signaling financial strength. No guarantees, but you get an idea that they're a well-run company because they're prepared to meet, whatever the claims are going forward. So if you understand that they're investing in kind of treasury bonds and they're throwing off interest, now that lays the groundwork for these fixed index annuities, because the fixed index annuities are often promoted to people as ways of getting market-like performance with no risk. And that's a lot of sales talk, but it's not untrue, right? It has some measure of truth in it. We just got to figure out where it is in all of that marketing talk. The way the fixed index annuities work is that you put your money in a contract with the insurance company, and they're going to invest it in these treasury bonds. And those treasury bonds are going to throw off interest. And with that interest, they are going to buy options to participate in an index. Okay? So they're not investing in the index per se, but what they'll do is they'll buy an option. Now, if you don't know anything about options, the way they basically work, it's the opportunity to buy something. In the way that the options that they select work is they have the opportunity to buy the index back at the time that you put the contract in. So you work backwards, right? So I buy options to buy it today, and I can have a year to exercise those options, or 2 years to exercise those options, depending on the index. So a year from now, I'm going to look at the way that the index performed. And if that index went up, I will exercise my option, buy the index value, and then sell it immediately to get all of the gain, right? So you have a chance to participate in there. If the index goes down, I will let my options expire. Just won't use them at all. All right? So when we think about how it is that they can say that they have market-like performance without risk, what they're basically saying is that your principal is safe. And we've taken a portion of the interest and we've invested it in the options. And if the options work out to our financial benefit, we'll exercise them. We'll let you make money on it. And if they don't, we'll let it go. And your contract value hasn't gone down. And that is a true statement and is one of the reasons why it's a powerful investment tool, because it gives you the opportunity to have principal protection, basically that your money doesn't go down, and get some participation in the market. Now, the insurance company is in the business of making money too. So what they're going to do is they're largely going to cap or somehow participate in the index along with you. So you don't get 100% of the participation. And the amounts that they allow you to participate or not is driven by the cost of the options at the time that they buy them. All right. So hopefully that'll give you a little idea about the way fixed index works. And when we come back from the break, I'm going to talk to you about how to examine the contracts, what to look for, and figure out whether or not one is right for you. Stick with us. We'll be right back on Make It Last.
Hey, it's Bert. I hear a lot from people that the one asset they're most interested in protecting from the devastating cost of assisted living or nursing homes is their own home. The team at Medina Law Group can meet with you to discuss options to help protect that home, including their special Home Sweet Home Trust. It's designed specifically to protect the value of your home in the event that you need long-term care in the future. Just call the experienced elder law attorneys at Medina Law Group at 609-818-0068 to learn more, including your chance to schedule a free consultation. You can also visit MedinaLawGroup.com to learn more about protecting your assets and the Medina Law Group team. For peace of mind and a solid foundation, call Medina Law Group at 609-818-0068 or visit MedinaLawGroup.com.
All right, welcome back to Make It Last. We've been talking about annuities today, and now I finally get to tell you what to look for in your contract so you can get something out of it. Now, look, annuities are sold and sold and sold and sold largely because they have such high commissions that are associated with some of these products. So insurance agents look at them and they say, home run, can't wait to sell someone an annuity because I can make 7, 8, 9, 10% on the contracts depending on what I can convince them to buy. And if you're working with somebody like that, like A, I'm really sorry for you. And B, I have to kind of watch out because these things are so confusing. There's so many insurance companies that are out there. And so every one of them has a different flavor of whatever they're offering. And you kind of have to understand the way the engine works underneath the hood of the car to know whether to have a good one or a bad one. So let me tell you a little bit about the way that annuities are structured generally, and then how they're oversold and what to look for, and then what we think are important factors of them. So the insurance company does not want you to have your opportunity to kind of put your money with them and then take it away right away, because they are long-term investors like you. They want to be long-term investors. And so one of the basic tenets of an annuity contract, specifically a fixed index annuity, is that there is a schedule of surrender charges. And the surrender charges are essentially your commitment to keep the money, the largest part of the money, with the insurance company over a period of time. Now, those surrender periods can range. You can get some as short as 5 years. You can go some as long as 20 or more years, depending on the contract. Now, I'll tell you straight up, 20 years, way too long for any contract. And those are the bad ones, the ones that are super long. But 7, 10 years, for the right investor, I think it's an okay trade. With the idea being is that they don't want you to kind of give your money and then take it right back. They need to have some opportunity to make money on it for them to stay in business. And so there's a trade-off in that for the way the contract's written, where you're going to keep your money there for a period of time. Now, you don't have to keep 100% of your money there. The surrender charges are above what's called a free withdrawal. And so on an annual basis, you'll be able to take out a certain amount every year. And again, it depends on the contract. Some people will take out 7% per year. Some will allow you to take 10%. We even have contracts that will allow you to take up to 20% on a 2-year basis so that you don't lose that year that you choose that to take something out. Gives you a little bit more liquidity. And when those surrender charges are presented to people, often they are glossed over. Not in my office. When we talk about them hard. I have people initial so they understand what they're doing and they really get why they're using this product in their portfolio as part of the solution. Because the surrender charges are big and we don't want anybody to be unaware of the fact that they have to kind of commit their money over there. So we go to from the surrender charges to different contractual guarantees. At the end of the day, the more you ask the insurance company to do with this, the more they're going to ask from you back. So, for instance, if you're going to want a very high indexing opportunity, where you're going to be on a 3-year cycle or something like that, they're going to want a surrender period for maybe 9 years. If you want to participate 100% in a index, more than 100%, they might charge you for that. And so one of the biggest problems with annuities are the way that people load them up with rider charges. So rider charges are basically what you pay for certain contractual guarantees. So if you've been promised in an annuity an income benefit, many times that income benefit, so that income benefit basically being that you're going to be able to get a certain percentage guaranteed over a period of time, that usually comes with a rider charge. That rider charge is there to make money for the insurance company and be able to stand behind their guarantees. But, and here's the trick, it's also the way that they pay the insurance agent a higher commission. So my experience has been that the more riders are associated with a contract, the higher the commissions are. And so if you're meeting with somebody that's telling you that this annuity does everything in the world, it slices, it juliennes, it's a Swiss Army knife, it's largely because it's loaded up with rider fees, and those rider fees have increased the commission. And so the insurance agent is selling you this because it's paying 10, 11, 12% and tying up your money for a very long time. And of course, that's a disservice. We don't want to see any of that in any kind of situation for clients, but you have to be looking out for that because, again, the more that you ask the insurance contract to do, the more the insurance company is going to ask from you. It's nothing secret about that. When we look at the way the contractual guarantees work for principal protection as well as for indexing, you need to understand that the indexing options are numerous, right? So everyone's kind of familiar with the S&P 500. That's one that tracks the 500 largest domestic companies in the U.S. and is a reflection of their performance. The S&P goes up, the S&P goes down. And the S&P is a pretty easy one for people to understand in terms of indexing because they see it reported fairly frequently. The S&P also happens to have an adjustment annually for inflation, and so it's a measure of, a good measure of where the performance of the economy is at any point in time. So S&P is a pretty good index, or rather, I don't want to say it's good, but it's a frequently used index because it is something that people understand well. But there are other indices there too, and some of them are created to mitigate volatility. Basically, they'll draw from multiple asset classes. So if the S&P is only the 500 largest U.S. domestic companies, a representation of those companies and their performance, you might have another index that draws from global companies, that comes from commodities, that blends those things together so that you have a smoother ride and so that you can expect a little bit better performance over time. And they'll give you the historicals on that. And we choose to use a lot of those indices in the products that we write, the more volatility controlled ones, because first of all, we're able to explain them to clients, I think, in ways the other advisors can't, so they get what they're investing in. But also because the goal of the annuity is, no home runs. We're not looking to hit anything out of the park. What we want is some steady, controlled growth. We want to mitigate our risk of longevity and our risk of market performance, specifically in retirement. So when we kind of blend those things together, we say, well, the index that works best for you over time is going to be this kind of index that controls for volatility. And that's important. It's important to make sure that you understand what you're investing in when you use a fixed index annuity, because part of the reason why you're doing that is to participate in some of the growth going forward, that the contractual guarantees are working to your favor so you can have this thing grow over time in some, I don't want to say guaranteed way, but some reliable way, a way that you understand that's not going to be tied to market performance. It's sort of a counteracting investment, so that it doesn't matter what the market's doing on the right-hand side. This over on the left-hand side is providing some steady growth or steady value for you. So the fixed index annuity with their indexing options also often come with the opportunities to have income guarantees. So if you think about your retirement income as being basically two buckets, right? On the left-hand side, you have your required spending. And so your required spending are the things that you need to do to feel comfortable, kind of peace of mind that you're not going to go broke and, die penniless in a gutter someday. So it's going to be your housing costs and your food costs and your clothing costs and, your property taxes and those things that are mandatory spending. And you want to meet mandatory spending with guaranteed income. So, for instance, if you have Social Security and a pension, and that only adds up to 80% of what your required spending is on that mandatory side, you might look at one of these products as being a way to make up that 20%. So you'll carve out a portion of your portfolio so that it fills up the rest of that bucket on a mandatory spending. Then the other hand of the retirement stuff is the discretionary spending, and that's the fun stuff. And that's the stuff that has to do with travel, and, the things that you might want to leave behind as a legacy, those things that aren't essential to your well-being, and the same way the mandatory ones are. And that you can do with investments, and you can do that with things that, you don't need the contractual guarantees. But if we look at the income benefit off of a fixed indexed annuity, many times that income benefit is serving to fill up the rest of the mandatory spending bucket, that extra 20%, let's say, that we're using to make sure that we won't ever outlive our money. And that's a good use of it. So I've spent a lot of time describing the way these things are set up. Here's 3 things that you can look for to evaluate your annuity. First, look at the surrender period. My experience has been that anything longer than 10 or 12 years is too long for a contract, especially for somebody that's nearing or in retirement. The second thing you want to take a look at is what your opportunity to participate in the index is. Many times it's limited, so you might have a cap on it, and you want to look at what that cap is. There might be what's called a collar or a spread, and that's basically that the first portion of it is the insurance, and then you get what's over it. So you want to evaluate what your indexing options are and how often you can redo them, choose a new one or reallocate. And the last thing you want to look at is rider charges. So many times that there is embedded fees in there on the riders that are decumulating your cash value, making it lower. And the insurance company, they run 2 different books. They have your income benefit, and that's one number, and then they have your cash value or surrender value, and that's another number. Well, the one that you're really worried about is your cash value, because that's really your money. The income value is it's a method of doing math for the insurance company. It's not really your money. So you want to look at those, because if you have a lot of rider charges, if you're paying 2-3% annual in rider charges, it's probably too much. Now, look, if you have any questions about your annuities and you want to know how to get a good one, you can call us. You can reach out to us, and you can, have an evaluation with us. We're going to be able to take a look at that. If you're interested in them, we can tell you what the good ones are and help you get into them. If you're wondering if you have a good one and you want to figure out how you can get out of it, we can help you with that as well. But we can kind of take a look at those and help you. You just have to contact Private Client Capital Group or Medina Law Group. Just find me, reach out to us, and we can help you with that, because this is one of the biggest abuses out there, and we really want to make sure that people are in a right setting, when it comes to their annuities and making sure that it works with their portfolio. All right, so that's it for today. Look, more of me coming up in the future. I promise, as well as more education, more fun in the radio show, and everything that you need to be planning for retirement. I want to thank everybody for joining us today. I'm not going to ask you to go to iTunes and leave a review, except I just did. So there, go to iTunes, leave a review. And if you're interested in any particular topic, you want to hear more about us, go ahead and to send us an email at feedback@makeitlastradio.com, or send us a personal email. Just let us know how we're doing. I want to thank everybody for joining us. We're going to catch you next week on Make It Last next Saturday, where we help you keep your legal ducks in a row and your financial nest egg secure. See you next time.
The foregoing content reflects the opinions of Medina Law Group, LLC and Private Client Capital Group, LLC, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal strategy. There is no guarantee that the strategies, statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs.